Past performance is no guarantee for future results. Any views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared during the event cannot be guaranteed. Content is offered for information purposes only. All event participants must comply with Seeking Alpha's events policy. Analysts, investing group leaders, and other third parties participating in the event include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank.
Thank you, Rena. It was great to hear from Steve and Rob. I'm Julie Morgan, host of Seeking Alpha's Wall Street Breakfast podcast, and I look forward to continuing today's conversations with an in-depth presentation by Seeking Alpha analyst Dividendology, whose actionable content has earned him significant followings across YouTube and, of course, Seeking Alpha. Please join me in welcoming Eli with Dividendology. Eli, thank you so much for being here with us today and sharing your strategies for dividend growth investing.
Yeah, thanks so much for the opportunity. I'm looking forward to it.
Before we dive in, I'd love to have our audience weigh in on which factor most influences their choice in dividend growth stocks. Please head over to the polls button in the panel to the right of your video screen to let us know how you typically make dividend stock decisions. I'll tell you the poll question. Which factor most influences your choice of dividend growth stocks? Is it A, consistent, above average dividend growth over the past decade? B, low payout ratios and strong free cash flow generation? C, strong competitive moat and pricing power within the industry? Or is it D, long-term capital appreciation potential coupled with dividend growth? We'll give you some time to answer that, and when I come back, I'll tell you what you guys said in the poll. So Eli, go ahead, take it away.
Yeah, that was a great question. I look forward to hearing the responses here in a little bit. Even more excited to be speaking on the value of dividend growth investing. And just based off a quick glance at the outline, there's obviously a whole lot that I want to touch on today. So I know we have limited time, so I'll try to move fast and see if we can get to all of it. Now, when we talk about dividend investing, as we're learning today, there's a lot of types of dividend investing, and usually we kind of get clumped into one category, but that simply shouldn't be the case. For example, we're hearing from speakers today on high yield dividend investing, people looking to maximize dividend income right now. We have defensive dividend investors, people who are typically seeking capital preservation, more lower risk tolerance. And then we have dividend growth investing. And the way I would define this is investors looking to maximize dividend income and returns over the long term. Now, saying you're looking to maximize dividend income with dividend growth, to some people is kind of controversial, but we'll address that here in just a moment. Now, for me personally, when I talk about dividend growth, I typically do it with the long-term goal being to either live off dividends or use it as supplemental income. So you have to decide where you want to be on the dividend growth pyramid, and thanks to my friend Jake for sharing this image with me. But to decide where you want to be on the dividend growth pyramid, you have to ask yourself things like, what's your time horizon goals, risk tolerance? So for example, someone like me who has a longer time horizon looking to one day live off dividends, I'm going to be closer to the top of the dividend growth pyramid. We have stocks that are lower yields, Costco, Visa, and Lowe's, who have double-digit dividend growth but lower yields. And then at the bottom, we have stocks like Realty Income, much higher starting dividend yield but lower dividend growth. And we'll talk more about how you determine where you are in the dividend growth pyramid here in a minute. But earlier I said dividend growth stocks tend to pay out more over the long term. How is that? Well, what we can see is based off these assumptions, lump sum, not reinvesting dividends. Yes, high-yielding dividend stocks will pay out more in dividends over the short term, but because dividend growth stocks can rapidly increase their dividend payouts, over the long term, they can actually pay out more in dividends. And if we actually do reinvest dividends, we can see the same is still pretty much true. It just takes a little bit longer for dividend growth stocks to actually surpass higher yielding investments. So when we think about dividend growth stocks and we're looking at these lower yields, we have to remind ourselves we're not just buying these stocks for the dividend they're paying right now. We're buying them for the dividends they're paying 10 or even 20 or 30 years from now. And we actually have a great example of this over the last 10 or so years. AT&T was a very popular dividend stock for quite some time over the past decade. And in 2015, they had a pretty high starting dividend yield, sitting at about 4.2%. But if we fast forward around 10 years, we can see the yield on cost is now sitting at about 3.21%. But if we compare this to a dividend growth stock like Domino's Pizza, who in 2015 had a starting dividend yield that was below 1%. But if we look at that yield on cost as of 2025, it's sitting at about 5.95%, and that doesn't even account for the recent, I think, 15.2% dividend increase the company just announced, which would push their yield on costs at above 6%. So we're talking about in just a 10-year time period, dividend growth stock surpassing a higher yielding stock. And yes, in this example, AT&T did reduce their dividend, but even if they maintain their dividend or grew it at around 1 or 2%, Domino's Pizza's yield on cost still would have surpassed that of AT&T. So just think what's possible if you look at it on a 20 or even 30-year time horizon. Now, when we think about dividend growth investing, yes, we have the typical metrics we think about: dividend yield, payout ratio, we have dividend growth rate, and dividend history, but we don't talk as much about free cash flow, which is a huge mistake because this is the single most important metric because all the other dividend metrics tie back into free cash flow. So why do we focus so much on free cash flow versus things like maybe adjusted earnings or EBITDA? Well, it's pretty straightforward in reality. Free cash flow is going to reflect the actual cash generation for the business. It's going to indicate financial health, and perhaps most importantly, it's going to minimize accounting manipulation, which is actually more common than we like to acknowledge. So let's talk about some examples of this where adjusted earnings or the PAE ratio might be off. And we can see in 2018, GE had asset sales that inflated their earnings and it masked operational struggles. Fairly recently, we had Amazon in 2023, was trading at a PE ratio of 250, but in reality, this was distorted by Rivian-related losses. And then we have an example with Boeing. The PE was inflated during the 737 MAX crisis. So what we can see is we focus on free cash flow because it's very straightforward. So once we get to free cash flow, we determine we're looking at free cash flow. Why is this relevant? Well, we have to understand capital allocation and how capital allocation is the single most important job of management. And with free cash flow, a company has 5 options. They reinvest for organic growth, they can attempt mergers and acquisitions, pay down debt, buy back shares, or pay out dividends. So what do we want to look for from a capital allocation perspective when it comes to dividend growth stock? We can look at a couple of examples, and one of the examples we can talk about is Johnson & Johnson. So Johnson & Johnson lays out very clearly in their investors presentation what their priorities are. And we can see that the top priority is reinvesting back into the business for organic growth. And then coming in at number 2 would be competitive dividends. And this is typically what we want to see from dividend growth stocks. The main priority should be reinvesting back into the business so they can grow free cash flow in the future, thus growing those dividend payments. So if we look at another example, Visa, one of the positions in my personal portfolio, the main priority is reinvesting back into the business, but then pay close attention. It says they pay 20 to 25% of earnings per share in the form of dividends. So what does that mean? Well, if we see if we see earnings grow at about 15% and they want the dividend payout to remain in that 20 to 25% range, then we're probably going to see the dividends grow at a rate of around 15% as well. So that's why the main priority we want to look for is typically going to be reinvesting back into the business, probably followed by dividends in most cases. So we've touched on free cash flow. We understand why it's probably a better metric in most cases than things like earnings. But what about these 4 other metrics: dividend yield, payout ratio, dividend growth, and dividend history? Well, dividend yield is pretty straightforward. We all, I think, probably understand dividend yield. If I were to invest $100 into this example, Domino's Pizza, in year 1, it'd pay about $1.33. But let's take a closer look at these other metrics. Now, when we think about payout ratio, typically we'll think of just a single metric. We look at the earnings payout ratio for the trailing 12 months, or maybe we look at it forward looking. But there's a lot more that we need to understand when it comes to the payout ratio. Now, to start off, I'd argue, again, in a lot of cases, we should probably be focusing more on the free cash flow payout ratio. How much of the company's free cash flow is actually being used to pay out dividends? It's a good way to understand dividend sustainability. But one of the things we don't typically look at, which we certainly should, is how is that free cash flow payout ratio changing over time? So again, we're looking at a Domino's Pizza example, and we can see over the past decade that free cash flow payout ratio has ranged from around 40 to 25%, which is a very healthy payout ratio. Now, that's impressive because they've grown their dividend at a really high rate during that time period. One of the things we have to keep in mind, a stock could maintain high dividend growth for a short time period, but if their free cash flow payout ratio is growing simultaneously, eventually that dividend growth is not going to be sustainable. So if a stock's growing that dividend, but the free cash flow payout ratio is growing over time as well, that's not a good sign. In the case of Domino's Pizza, they've grown their dividend at a high rate and maintained a low free cash flow payout ratio, something we obviously love to see. And one of the easiest ways to visualize this is simply by looking at the amount paid out, the amount generated in free cash flow versus the amount paid out in dividends, and we can see this charted out here on the bottom. Now let's get into the weeds of dividend growth specifically a little bit more and why dividend growth matters. Now, we understand, as we saw earlier, dividend growth is going to pay you more in dividends over the long term, but we also have to think about things like what does a company increasing dividends actually mean? What is management team telling us? Well, the management team typically grows dividends when they're confident in the future earnings potential of the company. Not only that, but dividends also force management to prioritize the highest return on investment projects, which we'll see in a case study just a little bit in this presentation. Now, another one of the reasons that dividend growth obviously matters is because inflation compounds over time, just like any other investment. So when we think about dividend growth specifically for potentially living off dividends, like we mentioned earlier, again, if we assume our cost of living right now is $4,000 a month, which obviously will vary a lot depending on different circumstances, but if we're optimistic about inflation over the next 30 years and it's only 2%, still in 30 years, our cost of living will be close to $7,500. So if you're utilizing high yield stocks, to really boost your immediate dividend income, but they're not growing their dividend, eventually your cost of living could surpass your monthly dividend payments. Now, there are other strategies such as reinvesting a portion of those high yield dividends to continue to boost your monthly income. But as a general basis, we at least want to see dividend growth at a rate that is beating inflation. And a lot of the times we'll see some of these stocks, increase their dividend maybe 1 or 2%. But in reality, if you're not increasing it at a rate above inflation, then you're technically paying out less in dividends. So another one of those red flags to look for. Watch out for the companies that might maintain their dividend growth streak, but in reality are growing it at a rate below inflation. Now, this is quite straightforward. The reason so many people love dividend growth is, historically speaking, it's outperformed. And Hartford Funds had a phenomenal study on this that found that dividend growth stocks outperformed since 1980. And we can see the different examples here charted out. But the question we have to ask ourselves, is this correlation or is this causation? And the reality is this actually isn't causation, it's more correlation. These stocks that are growing their dividends outperform the market because these are the same stocks that grow their free cash flow over time. Now, when we think about market volatility and a dividend growth strategy, we have to acknowledge a few things. If we look at the S&P 500 annual returns over the past 100 or so years, the market is volatile. It's really clear. We had in 2022 a market drop of nearly 20%. We saw during the global financial crisis a drop of nearly 40%. And this can be devastating in a lot of scenarios. And so we have to understand the implications of market volatility. We always tout these average returns of around 8 to 9% when it comes to the S&P 500, maybe closer to 7% if we adjust for inflation. But we have to understand the average return is not usually what happens. If we look at the distribution of S&P 500 returns over the last 95 years, what we can see is years where it returns negative 10% to 0% are just as common when the market returns 0 to 10%, which would be in line with the average. So these new investors get into the market with these expectations of this average return of maybe 8%, and then are shocked when they have years where it's maybe a 20% return or a negative 10% return. Now, this is a big deal because what it does is it exposes us to what is known as sequence risk. And this is specifically referring to people who are close to retirement. Okay, so sequence risk refers to the risk that the order and timing of investment returns can negatively impact a portfolio. And so poor returns early in retirement can significantly reduce the longevity of a portfolio, even if your long-term average returns are actually quite strong. So we can see this charted out here. Investor 1 experiences a 15% decline during the first 2 years of retirement, and investor 2 experiences a 15% decline during the 10th and 11th years of retirement. So even if they have the same average return, sequence risk is a major threat. But here's the beauty of dividend growth investing. Dividend growth can eliminate sequence risk. So let's look at an example, a simple example with the S&P 500. In the last decade, the S&P 500 had years with returns of around negative 18%, negative 6%, and even negative 1%. So 3 years of negative returns during a pretty large bull market. But even during those years with negative returns, the S&P 500 was able to grow their dividend every single year. Keep in mind, the S&P 500 technically isn't even considered a dividend growth ETF. So just think what's possible when you buy dividend growth ETFs like DGRO or SCHD, who since I think 2018 has grown its dividend at a rate of about 13%. So very high dividend growth, even during years where we see drawbacks in the market, like in 2022. One of the things we also have to understand is dividend payments from the S&P 500 are much more less volatile. And we're still talking about the S&P 500 ETF that's not technically a dividend growth. So the average decline of the S&P 500 during a bear market since 1946 is nearly 34%. So we're talking about a drastic pullback in the market. But the average dividend change for the S&P 500 during bear markets is only negative 0.5%. So we're talking about a drastic difference in the price fluctuations versus the dividend fluctuations. And again, I have to reference dividend growth ETFs because most of those ETFs will actually be positive even during bear markets. So your dividend payments are continuing to grow regardless of what's going on in the market. So what we see is dividend growth, yes, it outperforms as we've seen, but it especially outperforms during bear markets. So if we look all the way to the right, overall, yes, dividend growth outperforms, but look in the middle at the bear markets. Non-dividend payers were declining from 1978 to around 2023 at about negative 30% during bear markets. Meanwhile, if we look at dividend growers and initiators, they only declined at about 11.7% while continuing to grow those dividend payments. So let's look at a case study at what I think some people think is controversial, but the best companies in the world actually pay dividends. And we saw this with Meta and Google as well in the last year. So when we think about Meta, this is a company that has a 10-year revenue CAGR of close to 30%. The same is true with net income. They're generating billions in free cash flow. They weren't actively pursuing any acquisitions to my knowledge, and they virtually had no debt to pay off. So when we think about Meta, basically they're drowning in cash. They have more cash than they know what to do with. So obviously the main focus for these growth stocks is they're looking to reinvest back into the business. Now, the problem is when you have that much capital, it starts to become difficult to reinvest all of it at an intelligent rate. So what they did is they spent 45 billion on Reality Labs, which is their metaverse, and it proved to be quite unprofitable. So that's essentially 45 billion that had zero return on its investment. If they would have used that 45 billion to actually pay out a dividend, it would have boosted the total return of the stock. So we have to remember any capital that can't be reinvested at a high return on investment should be paid out as a dividend. It's really that simple. And it's not an indication that, Meta's best growth days are behind them. It's an indication that this company is generating so much free cash flow. The balance sheet is so healthy. They have more capital than they know what to do with. And these are the exact type of companies that should be growing and paying out a dividend consistently. And Microsoft is a great example of this. People don't typically think of Microsoft as a dividend stock, but when you look at that dividend history, the dividend growth rates, it's a phenomenal example of a very good dividend growth stock that's still getting very high free cash flow growth rates. Now, one of the objections we typically see when we talk about stocks choosing to start paying out dividends is, what about share buybacks? And this is a very fair question. And in the grand scheme of things, it's really going to depend which is best for the company. But when we talk about it from a shareholder perspective, what we can see is dividends are much more predictable and reliable than share buybacks. And I've pulled an image from ADM's investor presentation, and we can see their returns to shareholders in the form of dividends versus the returns with share repurchases. And dividends, as we see, they're growing at a healthy rate over time. They're more predictable, they're more reliable. So for someone looking to utilize this as supplemental income or even live off dividends, that's exactly what we want to see. Now, if we look at share buybacks, the same is clearly not true. They have years where they might do a lot of share buybacks versus years where there's virtually no share buybacks. Now, with all that being said, we also have to keep in mind share buybacks also have the potential to destroy shareholder value when done at an overvaluation, and buybacks can occasionally misalign management incentives if they're trying to artificially maybe boost earnings per share to potentially hit a bonus. So that's not what we're looking for. Now, when we think about diversification specifically for a dividend portfolio, there's really two ways of thinking about it. And the first is one that we probably all know. We spread our investments across different assets to reduce risk. And what we found is after around 20 to 25 holdings, adding more stocks to your portfolio doesn't do a whole lot in terms of diversification. But what a lot of people fail to look at specifically with dividend portfolios is diversifying your income. And so the simple example, let's say we have a portfolio and maybe REITs make up about 10% of that entire portfolio, which isn't an over allocation in my opinion. But if those REITs are generating 40 to 50% of our total dividend income, that's a major risk. That's a major threat. So we don't want to just think about allocation from an individual stock or sector allocation. We want to look at where our dividend income is coming from, because if REITs are making up 40% of our income and something happens in the REIT market that's potentially devastating, that's a huge risk to our portfolio. Now, I do want to quickly touch on valuation of dividend stocks, and obviously we could spend a lifetime talking about this with all the different valuations. Valuation is much more of an art than a science, but if you're just getting started, there's really three fairly straightforward and simple valuations you can use to kind of understand how a dividend stock is trading. And the first one is very straightforward. It's dividend yield theory, and the core idea is that a stock's dividend yield tends to revert to its historical average over time. So in this example we have pictured, the average yield is around 3%. So when it's under that, it would be overvalued, and when it's above that, it's going to be undervalued. But it's a straightforward model, but it certainly has its faults, specifically when the potential future growth projections of a company have changed. It's not going to really hold up. Now, the next one is Bogle's valuation, and this doesn't give us a specific buy price, but rather projects future returns. So it's fairly straightforward. We look at earnings growth, we look at the shareholder yield, which is simply the dividend yield plus the buyback yield, and then we project if there's going to be multiple expansion or multiple contraction. So we might want to do this over a 5 or 10-year time period, but we just apply the earnings growth projections, which I'm pretty sure you can pull from Seeking Alpha. You apply the shareholder yield, which is very straightforward, and you can get your expected return on an annual basis. So when done well, it's actually quite an effective valuation model. Then finally, we have dividend discount model. We value a stock based on the dividend that's paying out now and the dividend growth rate that we think it'll achieve in the future. So we have an example here. We see the dividends paid out, we see the dividend growth rate, and the value of that stock would be about $518.23. Now, the last thing that I do want to quickly touch on is going to be taxes. And obviously, this is going to vary based on a lot of variables, and definitely talk to your accountant before pursuing any tax strategy. But we see this investing lie quite often that dividends are an inefficient investing method from a tax perspective, but specifically when it comes to either retiring early or living off dividends, or even using dividends as supplemental income, dividends are actually quite tax favorable. A lot of people don't realize this, but you could live off $126,700 of dividend income and pay $0 in federal taxes in 2025. Now, that assumes that you're married filing jointly, but if you're single, it'll actually be around $63,350. So if we put this into perspective, you'd actually need a $165,000 salary from your job to have the same net pay of $126,700 with qualified dividends. Now, the key word there is qualified dividends. If it's unqualified, this won't apply. And keep in mind, not all the time, but a lot of those higher yielding investments like REITs, for example, are going to pay unqualified dividends. This does also assume that you don't have other income sources, but even in the case that you did, for the most part, the tax rates will be quite a bit more favorable. But keep in mind, qualified dividends do get preferential tax treatment. So with that being said, Julie, I'll turn it back over to you.
Thank you so much, Eli, for such a thorough and insightful presentation. We really appreciate that. Now, before we get to the Q&A, I wanted to revisit our audience poll question that I gave you at the beginning of the session. The question was, which factor most influences your choice of dividend growth stocks? And it looks like most of you, 50%, said D, long-term capital appreciation potential coupled with dividend growth, followed by A, consistent above average dividend growth over the past decade, then B, and then C. So Eli, we have about 4.5 minutes left for some Q&A, so let's jump right in. Let's see here. Matthew is asking, how do you assess buy, no buy, analyzing payout ratio and dividend growth rate of 3 or 5 years?
Yeah, that's a great question. And we have to keep in mind these, payout ratios, these dividend growth rates, in reality, they're backwards looking metric. And there's obviously a lot of value in looking at that because we can kind of understand what the priorities from a management team are. But when we talk about what it's going to do in the future, we have to, again, go back to free cash flow. How's the company projected to grow their earnings? How's the company projected to grow their free cash flow? If we see projections look good, then I think those levels of dividend growth are going to continue to be maintained. They're going to continue to sustain. So if you see things like payout ratio growing over time, the company probably can't grow their free cash flow at as high of a rate over time. So yes, those metrics do have a lot of value, but we need to make sure we're looking at forward-looking metrics at the same time. So there's probably, when it comes to buy/no buy situations, there's probably a little bit more that we'd have to look into. We'd have to consider the valuation quite a bit more. But specifically with the metrics you talked about, the backwards looking metrics have a lot of value again, but we want to make sure we're also thinking about the forward looking metrics.
All righty. Thank you so much for that answer. And also thank you to everyone who's submitting questions. All righty. Sean is asking, do you prefer to enable DRIP?
Yeah, I'm a big fan of DRIP. Dividend reinvestment obviously plays a major role in the compounding, but think the question a lot of people have is, do I receive those dividends and then choose how to properly reinvest it into certain places in my portfolio where I think there might be undervaluations. And I think there might be times and situations where that might make sense. But for the most part, I want the investments I make to be so good that I'm completely comfortable reinvesting dividends for the long term. So there's a lot of different strategies with that, but me personally, I do reinvest all my dividends back to where they came from.
Okay, and so that really answers the next question, but I'm going to ask it anyway. Mary is asking, are your strategies and stock picks focused around having drip set up?
Yes, I would say the vast majority of time the answer would be yes. We're looking for stocks that can, well, let me back up. We're looking for stocks that would allow us the potential to one day live off dividends. So that being said, we're looking for stocks that can maintain their earnings and free cash flow, grow their dividends over time, and by that logic, we should be able to reinvest dividends to continue to grow those dividend payments we're receiving on a monthly basis.
All righty. Thank you so much, Mary, for asking that question. Now, Nick is asking, how do you find out what stocks or ETFs pay qualified dividends?
Yeah, that's a great question. So typically, your more standard business model, S&P 500 stocks, think of Lowe's, Coca-Cola, Microsoft. Those are going to be companies that pay qualified dividends. It's probably easier to explain which companies pay unqualified dividends. So, for example, REITs are going to pay unqualified dividends the vast majority of time. BDCs, a lot of the times, it can fluctuate a little bit, but those will be unqualified dividends. And then covered calls, it can fluctuate quite a bit. What percent gets taxed as unqualified, but a lot of the times, covered call ETFs are going to be paying unqualified dividends as well. But that's a great question and definitely something you should make sure you understand before pursuing any dividend stock.
All righty, let's see if we can sneak in a couple more questions. Judy is asking, let's see, does Eli have a Seeking Alpha service? What did
I
Eli
don't
have?
have a service on Seeking Alpha right now, but I'd love for you to follow me. I post my thoughts in other areas as well, if you want to learn more about my strategies.
So, Eli, that is all the time that we have. Any parting words?
No, I appreciate the Seeking Alpha team for letting me talk about this. I think dividend growth is a great long-term strategy specifically for people looking to live off dividends. So I hope it's something you'll look more into, see if it's a good fit for you. And again, thank you so much to the Seeking Alpha team for letting me speak on this today.
Oh, thank you so much, Eli. And also thank you to our audience for participating in our poll and Q&A. Now, before our next session starts at 1:20 p.m. Eastern Time, we'll take a brief break to allow you to step away for a few minutes, shake it off, and we'll resume with baby bonds and beyond, helping investors afford retirement. So we'll see you again shortly. Thanks.